But what's really important is after you go to closing, what do you do now? A lot of that stuff that we talk about in pre-purchase education kind of goes out the window once you get that exciting moment of you sit down and you go to closing, and then you're sitting there now with, okay, I have a home, I have a mortgage. What on earth do I do now? And so we just wanted to talk about a couple of things. You should have hopefully received an agenda that kind of walks you through what we're going to be talking about. And I'm going to go through the first one, which is really focusing on that financial management piece. So most of you, and to get a feel for it, how many of you felt that once you bought a home, your expenses were not what you expected them to be? You had an idea going in, but then a year after that, you sat down and you said, okay, this is not as much money as I thought I was going to be spending. So everyone was right on the ball. Pretty much the expenses were what you expected. Awesome. You guys are a really smart group then. More often than not, it's the opposite. People assume, okay, I've got a home now, and they really have to adjust to now being an owner versus when you're a renter, you have somebody else that's going to take care of things for you. So we've provided you with a nice little kind of like a job aid that walks you through what some of these expenses would be. And so your average expenses, when you talk about what your take home is, that's your net income, right? So you qualified for a loan based on your gross income. That nice proverbial number, it's that hypothetical number that we're all told when we're offered a job, but the one you never really see. So we always go off of what we call your net income, right? That's what you live off of, that's what you take home. So when we look at that, the average number that's a good number when you think about what your gross and your net income, your take home is, for housing, you probably don't want to spend more than 35% of your net income. Right, so we're talking your mortgage, which would hopefully include your principal, your interest, your taxes, and your insurance. Your taxes and your insurance are what we call, when you pay it to the bank, it's escrowed, right? Ideally, that's what you would be looking at paying. Try to keep it 35%, really not much higher than that. Then when we start talking about all your other expenses, right? So now you have credit cards. You may have had credit cards going into the loan. And definitely as time passes, you may have opened new cards, you may have opened an account to get furniture, things like that. But you really want to try and keep that debt down to about 15% of your net, right? So just trying to juggle when you look at your numbers, that's a pretty good safe number. When we think about transportation, and we live in the great state of Texas, right? Everything's bigger in Texas. Distances are huge here. 50 miles, we don't bat an eye at that here. Other places, people would freak out. But you have tolls here also, right? So transportation, and then add to that the cost of gas, because we do drive long distances, that's one of those expenses that adds up very quickly in your monthly budget. So 15% for your transportation is also kind of a good number when you look at just for planning purposes. And then a big thing that's very important to people like Jenny and I when we talk about expenses is the flip side to expenses, right? And that's savings. You need to make sure you're putting money away, especially for that rainy day. Because as I tell people, life happens. And it's oftentimes what you least expect it to happen, and what you least expect to happen, that's when it's going to happen, right? So things like an unexpected hailstorm, because we get a lot of those in Texas. So you have to pay the deductible for the insurance. The car breaks down. Public transportation it doesn't cover the whole metroplex. So things like that you have to take into consideration. So you always want to have money set aside for that just in case moment, right? And a good number is really that 10%. That's usually the golden rule of make sure you're putting 10% away, right? What other types of things do you look at when you're thinking about your monthly expenses? Yeah. Any other things? Food. You have to eat, right? So those are what we call your variable expenses, so they can adjust, right? They may go up one month, things like your utilities too, right? So looking at things like average billing for some of your utility bills, things like that help balance out those monthly, just your monthly expenses. Because in the summer, right now, everyone's running their AC, although we've been very lucky that this has not been as hot a summer as we normally get, right? But those months are typically when I see clients that call and they say, oh my gosh, I planned for $100 in utilities, but I got a bill for $350. What do I do now? So looking at things like that to help balance it. Another thing that I just want to make sure that everyone understands is for those of you that have your loan, especially for those of you that had loans for a really long time, how many of you have a fixed rate loan? Okay, so quite a few of you have adjustable rate mortgages. Yes? No? I don't remember? Are there a lot of, okay, so we have kind of a mix between the two. So one thing I want you all to remember is that when we talk about a fixed rate mortgage, the only thing that is truly fixed is the principal and the interest. The taxes and the insurance, those go up and down every year, right? So that's one thing that I want to make sure that everyone's always aware of. When we talk about fixed rate, it really just means that the principal and the interest piece, that's what's fixed. Your taxes and insurance, and we're fortunate that here in Texas, they really only adjust once a year because we only have to pay them once a year. That's gonna, that can obviously fluctuate depending on where you live. So that's something to keep in mind. And then if you're not escrowed, I would definitely think about making sure that that's a big one, right? Taxes, the county, they can actually foreclose if you don't pay your taxes. So making sure you have those things in order.